Hi traders, Ken Calhoun from TradeMastery.com here with the channel dedicated to helping you make bigger winning trades more often. In this episode, you'll learn the advantages to trading charts with wide trading ranges. We look at both volume and volatility as key technical indicators. The importance of your trading range, or the volatility, is one of the most important things to help you make more successful trades. Coming right up. So let me start by asking you a question. How many times have you been stopped out by a chart that had a good technical breakout pattern but had a false breakout? We've all been there, done that. One of the things that I've found really helps make a big difference, at least in my own trades, is focus on charts with really big ranges. And one of the most important technical indicators you can look at is the range. Now there's derivative technical indicators like the ATR, the average true range, and as you know, you want to trade when the ATR is going up, or Wilder's average directional index, the ADX. Similarly, it indicates volatility is increasing when it goes up. As a trader, you need to be keenly aware of the value and the importance and the profit potential of trading charts with big ranges. Take a look, for example, at this chart. Do you see how big the range is? Now take a look at this chart. See how compressed the range is. It's my contention, after having traded millions of dollars worth of real money trades over my career the last 20 years, that the range or the volatility of the instrument is more important than basic chart technical patterns. Because if you see a bullish cup, or a small gap, or an ascending triangle, or any of the other many Western technical breakout signals in a chart that has a choppy trading range, you're likely to get stopped out, regardless of correctly having identified a breakout signal or breakout chart pattern. So my point is, basic patterns alone are just simply not enough. You need to pay careful attention, critically important attention, to the point range on the right side of the chart. Now you may ask, what's a good range? I like to use, for example, as a rule of thumb, 10% on a 15-day chart for swing trades. So that means the $30 chart should have at least 3 points, preferably 5 or 6, but a minimum 3 points for a $30-ish price stock. Or for day trading, I like stocks with at least a 1 to 2 point range minimum for intraday trades. What you'll find is you compare the success rate, and think about it, go back over your last 100 or 20 stop losses, and you'll see that many of them were initiated on choppy charts that are inside the previous day's range, and the overall trading range is not enough points. What you want as a trader is to trade the outliers, the extremes, kind of like in a bell-shaped curve, the outlier extreme charts, ones that are extremely strong on the way up or extremely strong on the way down, that are either continuing or showing signs of a pivot or a reversal. Either way, pay careful attention to the point range. That's a lot more important than basic chart patterns. I wish somebody told me that 20 years ago. All the trades, it's like, yeah, I traded the cup pattern correctly, but I still got stopped out. Or I traded the ascending triangle correctly, still got stopped out. For a candle reversal, I bought the bounce and the hammer, but I still got stopped out. What's a trader to do? Stop the madness. Well, the challenge and the problem, the opportunity, is because the point range isn't big enough. First thing visually I look at when I look at any chart now is the point range. What's on the column on the right side of the chart? The underlying chart pattern, also critically important. How strong is the directional trend? Are there major versus minor pullbacks? What's the texture of any gaps that occur in the context of that chart? All that stuff is fine, but more important is volume and volatility. So we want high volume breakouts with highly volatile charts with more points of range. That's my number one tip, or what I hope you take away from this video, is spend a lot more time. You have my word on this, it's really important. Spend a lot more of your time technically looking for charts that have big ranges and great volatility and consistent chart patterns. And that's another kind of a word to the wise, or a warning for everybody. It's certainly appealing to trade cheap instruments because the percentage ranges are there. The problem with those charts, whether they're pop and drop penny stocks or rush up and down under $10 highly volatile stocks, is it's often too easy to be on the wrong side of that. And if you're trading large share size, which is another tip, don't over leverage yourself. You shouldn't be trading thousands of shares on margin or allocating 20% or 30% of your total capital account to any one trade. That kind of boneheaded mistake. Don't do that, because if you're trading large size on highly volatile stocks, especially ones with inconsistent trends like the cheap stocks, you're going to get killed, right? You're going to lose a lot of money because you'll buy what looks to be a good high and then it collapses 30% and you take a big haircut. So be careful when you're evaluating the profit potential of a chart that the range from a percentage standpoint should be high, which I get. You get that in spades in the cheap stocks, but if you do trade those, at least make sure it's in context of a strong directional trend or another pattern that works out reasonably well. For example, something that spikes, drops back down to support, and then tries to bounce may be a good bounce play. Or a mean reversion. It gaps up and fills halfway and starts to bounce. Or a breakout that pulls back to 50% and starts to bounce. Those kind of patterns are fine. But big picture, make sure you're trading highly volatile, highly liquid instruments with lots of volume to make your entries and exits much easier as well. So anyway, that's my tip of the video here for you guys, is make sure that you're spending more time on evaluating carefully the profit potential based on the trading range as a key determinant. Kind of like, when I hire employees, or if you've ever hired people, you look to qualify them based on the years of experience and their track record, their success rate of being able to reach milestones or goals or targets. As a chart trader, we're looking at qualifying your charts based on the trading range and make sure that they've got big ranges to qualify them from a visual scanning standpoint before you consider putting on that next trade. So anyway, I'm Ken Calhoun. I'd love it if you'd leave a comment or subscribe or forward this to a friend. And until next time, trade with intelligence, trade with tight stops, play the field, and let's go get them. Here's to great trades coming up, and I'll see you guys in our next episode. Bye for now.